Value stocks, often referred to as undervalued stocks, represent shares in companies that are priced lower than their intrinsic value, as determined by various financial metrics. Investors are drawn to these stocks due to the potential for substantial returns when the market eventually recognizes their true worth. Understanding the characteristics and advantages of value stocks can significantly enhance an investor's portfolio. To identify a value stock, one typically looks at key financial ratios. One of the most common metrics is the price-to-earnings ratio, or P/E ratio. A lower P/E ratio compared to industry peers may suggest that a stock is undervalued. Another important metric is the price-to-book ratio, which compares a company's market value to its book value. A value stock often has a price-to-book ratio of less than 1, indicating that the market values the company less than its actual worth as represented by its assets. A classic example of a value stock is Ford Motor Company during its challenging times in the early 2000s. At that time, the stock was trading significantly below its historical earnings and asset values. Investors who recognized Ford's potential for recovery benefited immensely when the company successfully turned its fortunes around. This illustrates the fundamental principle of value investing, buying low and waiting for the market to correct itself. Investors in value stocks often possess a long-term perspective. Unlike growth stocks, which may experience rapid price increases but also come with high valuations, value stocks typically grow at a slower, steadier pace. This strategy requires patience, as the market can take time to recognize the true value of a company. However, when the recognition occurs, the price appreciation can be significant. Additionally, value stocks can provide a margin of safety. This concept, popularized by legendary investor Benjamin Graham, suggests that purchasing stocks at a discount minimizes the risk of loss. If an investor buys a stock at a lower price, they have a buffer against possible declines. This is especially important during market downturns, where growth stocks may suffer more due to their inflated valuations. Another key aspect of value stocks is dividend yield. Many value companies have a history of paying dividends, providing investors with a steady income stream. This can be particularly appealing in volatile markets, where dividends can cushion the impact of stock price declines. Companies like Procter & Gamble and Johnson & Johnson are well known for their consistent dividend payments, making them attractive options for value investors. However, investing in value stocks does come with its challenges. One significant risk is the potential for value traps. A value trap occurs when a stock appears undervalued based on traditional metrics, but continues to decline due to underlying issues within the company or its industry. Investors must conduct thorough research to avoid falling into these traps. In recent years, the popularity of growth stocks has overshadowed value investing. However, historical data shows that value stocks tend to outperform growth stocks over longer investment horizons. This trend suggests that while growth stocks may dominate the market momentarily, value stocks can provide reliable returns over time, especially during economic recoveries when fundamentals take precedence over speculation. In conclusion, value stocks represent a compelling investment opportunity for those willing to do their homework and adopt a long-term perspective. By focusing on companies that are undervalued relative to their true worth, investors can potentially reap significant rewards. With the right approach, understanding the nuances of value investing can help navigate the complexities of the stock market successfully. Whether you are a seasoned investor or just starting, considering value stocks can be a strategic way to build wealth over time.